you wondering if a conventional loan is right for you? Hello, I'm John Thomas with Prime Residential Mortgage, and I'm going to walk you through the pros and cons of conventional financing for the purchase or refinance of a home. So let's start with, what is a conventional loan? So a conventional mortgage loan is a loan that is underwritten under the guidelines of either Fannie Mae or Freddie Mac, and those loans will be delivered to one of those two agencies on the secondary mortgage market. So they're going to be guaranteeing the loan when they purchase it if you underwrite it according to those guidelines. So as opposed to a conventional loan, you have other options like FHA, VA, and USDA, which are government insured mortgage loans and underwritten according to those guidelines. Now, if you fall outside of conventional or government, then you're going to fall into typically what's called a non-QM or non-qualified mortgage. Those options are available as well in the market. We're going to focus on conventional financing. So if you're looking to get a conventional loan or you have questions, you can always give me a call at 302-703-0727 or go online at DelawareMortgageLoans.net and get more information. So since these loans are not insured by the government, there's more risk to the lender because they don't have a government backstop. So the underwriting guidelines, the credit requirements, and the interest rates can all be stricter than a government-backed loan, say a VA or an FHA. So the one downside to the loans is they can have a higher cost associated with them than a comparable government loan. Now, are you eligible for a conventional loan? Well, typically the guidelines are pretty close to the same for Fannie or Freddie. Most lenders want a minimum 620 credit score to qualify for the loan. If you don't have that, you may want to consider like an FHA or VA loan, which will go below a 620. Now, the lender's going to review your credit background by pulling a credit report. They're going to look at your income and your liabilities to calculate what's called your debt to income ratio and determine if you fit inside the box for a Fannie or a Freddie loan. And typically those credit scores are higher and the box for the debt to income ratio is lower than on a comparable government loan. So that's one of the disadvantages. Now, when you're getting a conventional loan, you do have a choice on the term. You can go as little as a 10-year term, which means the loan will be paid off in 10 years and the payments will be amortized over 10 years. So the benefit of that is it's paid off much quicker. The downside is your monthly payment is going to be much higher. You can go a 15-year, a 20-year, a 25, or a 30-year. So your traditional 30-year rate mortgage has the lowest payment, but of course you're going to pay much more interest because you're amortizing the loan over 30 years versus the smallest term of the 10-year. You also have the choice between what's called a fixed rate mortgage or an adjustable rate mortgage. So the fixed rate, the rate is fixed for the entire term of the loan. An adjustable rate mortgage means the rate can change, but typically it starts with a fixed period, then it will adjust typically every year after that. Now, how much do you need for a down payment on a conventional loan? Well, traditionally it's 5% or more required down payment, but there is a special 97% conventional loan program where you only need 3% down. It's called a home ready for Fannie Mae or a home possible for Freddie Mac. So the down payment can theoretically be between 3 and 20%. There's disadvantages and advantages of putting more or less down. The least amount down obviously saves your cash, less money you need to buy the house, but you're going to borrow more, so you're going to have a higher payment. You're also going to have an adjustment to your payment because if you put down less than 20%, you're going to be required to pay what's called private mortgage insurance. So on a conventional loan, the mortgage insurance is bought through a private company, hence the acronym PMI. Those companies will assess your risk, and the higher the risk, the higher the PMI. So the less money you put down, the higher risk you are. Now, if you actually will put down 20%, then you don't need PMI at all because the lenders are saying you're not at risk. Now, the PMI or the private mortgage insurance actually protects the lender in case you default, and the risk of defaulting goes up if you put down less than 20%, hence the concept of PMI. Now, if you're a first-time home buyer, there are actually some programs to help you with your down payment and or closing costs when you're getting a conventional mortgage loan. So, for example, in Delaware, we have the Newcastle County DPS program, which can be used in conjunction with conventional loan, the Newcastle County Revamp program. Delaware State Housing Authority has two programs which can be used in conjunction with a conventional loan. There's the Small Down Payment Assistance Loan, or you can look at the Advantage 4 Grant program in conjunction with your conventional loan. You're also able to do what's called a Mortgage Credit Certificate program with a conventional loan, which is sometimes called the First Time Home Buyer Tax Credit program. That allows you to get a tax credit of up to $2,000 every year on your federal tax return that you have the mortgage. So that's another great program that can be combined with the conventional loan. Now, also when you go to buy the house, if you're short on cash, you can try a down payment program, but then you also got closing costs. You're able on a conventional loan to negotiate with the home seller to pay either some or all of your closing costs as long as they fit within the guidelines. So on a conventional loan, if you're putting down less than 10%, you can only get 3% from the seller, which won't cover all your closing costs in Delaware and in most states. But if you put 10% or more down, you're allowed to negotiate up to 6% of the seller paid closing costs. So that's a good rule of thumb to remember there. Now, there's also conventional loan limits where it's the maximum you're allowed to borrow. So the conventional loan limit as of 2017, the standard loan limit is $424,100. So in Delaware, there's 3 counties, Newcastle, Kent, and Sussex. It's the same in all 3. You can borrow a maximum of $424,100. Now, in some states, they have what are called high-cost areas. For example, Maryland has some high-cost areas where you can go above the $424,100, and they're called a high-balance conventional loan. So for those loan limits, it's going to be higher. Now, if you want to go above the conventional loan limit, whether it's the standard $424,100 or a high balance, if you're still above that, then what you're going to do, you have 2 options. One is to get a jumbo loan, which is one loan that's above the conventional loan limit, or you can break it up and get a conventional loan for the first mortgage for the $424,100, and then try and get a second mortgage for the remaining amount. So that's called a first and a second mortgage. So that's your 2 options if you need to borrow more than the loan limit for a conventional loan. Now, there's also a special product I mentioned earlier, the Fannie Mae 97% conventional loan or a Freddie Mac 97% conventional loan. It's a program designed for first-time home buyers with not a lot of money. They only have to put down 3% of the purchase price as the down payment. And Fannie Mae and Freddie Mac define a first-time home buyer as someone who's not owned the home in the last 3 years. There are income restrictions for the program. You do have to be under 100% of the area median income. And there is a website, Fannie Mae has to check that as well. So the down payment requirements, let's say you're buying a house for $200,000, you only have to put down 3% of that, which would be $6,000. Now you still have closing costs you have to worry about, but your down payment would only have to be $6,000. Now if you compare that to a traditional conventional loan, which requires 5% down, that would be a $10,000 down payment compared to $6,000. So it does help first-time home buyers get into a property with less money out of pocket. So the maximum you could borrow on a 97% loan would be the county loan limit of $424,100. So the maximum purchase price for that is $437,200. If you buy more than that, then you'd have to put down more than the 3% so you don't go over the maximum loan limit. Now, how do you apply for a conventional loan? Well, you can give us a call at 302-703-0727, or you can go online, www.delawaremortgageloans.net, and you can apply there as well. If you guys have any questions, I'd love to answer them for you. If you need a mortgage, I'd love to help you out. See you guys on the next mortgage program update.